we are now live. So, hello and welcome to those of you joining just a few minutes early. My name is Charlotte. I'll be your money show host for this session. I do have some of our fireside chat speakers here with me in the Zoom room. We're ready to begin on time at 9:30 a.m. Eastern Time, coming up in just a few short minutes. Thank you all so much for your patience.
As we sit here, if you're not seeing the same thing I am, we're just seeing headlines about airstrikes potentially against Hamas in Qatar by Israel. So getting a spike in crude oil. That's what we're talking here. Hmm.
Thank you, everyone, so much for your patience. We will not be having Daryl join us this morning. I'm going to go ahead and reschedule him for another session with us either tomorrow or at our next September show a little bit later today. But thank you all so much for joining us. We do still have just under a minute here before we get started. We do have Mike Larson, Elliot Gu, and Tim Plain in the room with us, ready for their fireside chat. We're very much looking forward to it. Hello, good morning, everyone, and welcome. It is my pleasure to introduce our Money Show editor in chief, Mike Larson, joined today by Elliot Q of Capitalist Times and Tim Plain of Investors Alley, a subsidiary of Magnified Communities. To our live audience, please share any questions you may have in the chat box, time permitting. We'll see if we can get to some of those at the end of the fireside chat. And Mike, with that all said, I will hand the microphone over to you. The floor is all yours. I'll be here if you need me.
Wonderful. Thank you, Charlotte. And thank you, everybody, for joining us. This is our kickoff event here for the virtual expo, which, as you know, is focused predominantly on opportunities in the oil, gas, and alternatives market in the energy space. But we're also going to be covering some of the other parts and developments of the market as well. So if you're energy inclined, you're going to get plenty of content and plenty of guidance from our experts. And if you're not, you're still going to get some information on what's happening in the markets, how you can position really in an environment that's been great overall for the stock market, really strong in many sectors. But energy's had some issues. You've had to sort of dig below the surface drill down. I had to use the pun in the space to find some different opportunities versus just maybe targeting some of the mega major type companies. But again, a lot of trends are out there and driving oil, gas, and alternatives. And you're going to hear all about them in the next day and a half, give or take, here on the platform. So with that out of the way, I do want to get this conversation started. Elliot, Tim, I really appreciate you joining me here on the platform. I know we were talking about a couple of the opportunities in the space a little bit off camera to set the stage, but I want to give you each a chance to just sort of tell the audience, big picture, what you're seeing in the markets, and then we'll drill down again into some of the individual picks. But Elliot, why don't we start with you, kind of set the table here for us?
Sure. Well, I think, the first commodity people think of when it comes to energy is oil. But the oil market hasn't actually been all that interesting in a while. Oil's been kind of trading sideways. It's been in a trading range for some time. Of course, the big issue there is OPEC adding barrels to the global oil market, increasing production again, taking back those voluntary production cuts. And for some time now, a lot of people have been looking for a big glut of oil on the global market. We haven't seen it yet in terms of showing up in developed world inventories, OECD inventories. And so I think a lot of that excess oil is ending up in China's strategic petroleum reserve. But longer term, I think oil is still very interesting. I think where we are right now, here in the 60s, is way too low. Oil really will need to be up around $80 to $90 a barrel to incentive enough production to meet growing global demand. This year, though, right now, I still think the more interesting opportunities are in natural gas. Obviously, we've seen a pullback in natural gas over the summer. A lot of that is due to short-term considerations. The coolest summer since 2021, believe it or not. And also, we've actually seen a big transition to coal-fired power in the first 6 months of this year because gas prices ran up into the first half of the year. And so coal is actually year to date in 2025, the first 6 months of 2025, relative to the first 6 months of 2024, coal is actually the fastest growing source of power in the United States.
Okay.
It's growing about 30% faster than solar. So longer term, you have an export demand story for natural gas. You have a in-basin demand story. In other words, you have AI data centers being built in places like Pennsylvania that are going to be powered by natural gas-fired facilities located on site. So sort of a captive source of natural gas demand in places like Pennsylvania, the Marcellus Shale. So I think that's the more interesting story out there right now, is natural gas and a lot of plays around that.
Okay, great. Tim, I know you're an income guy. I mean, you're looking, to get those dividend checks. Do people still get dividend checks? I guess you get it electronically deposited these days.
Yeah.
Talk a little bit about what you're seeing in the energy space when you're, recommending picks in there. What
Yeah.
are you looking for, and what's promising to you?
I agree with Elliot about, crude oil just kind of stuck in a trading range. Again, being income focused, most of my recommendations will be midstream companies, and midstream are in a great place just because of what he was talking about with, the expanded use of natural gas. Uh, the midstream companies that have the best natural gas exposure seem to be the ones doing better right now. But it's always about focus on dividend yield plus dividend growth and who's going to give you the best combination of that.
Yeah, okay.
I keep a couple of upstream energy companies in my portfolio. We can talk about them a little later. But my thought process on upstream, especially oil producers, is they're a hedge against something stupid going on in the world. We've seen it happen several times in our lifetime. Um, you know, just say somebody drops a nuke in Saudi Arabia. What's the price of oil is going to be the next day, or somebody sinks a super tanker somewhere. Price of oil could be 150 before you could blink. And that's kind of why I like just having a small portion of upstream companies, ones that pay dividends. So at least we get paid a little bit while we wait.
Yeah.
But I really think of upstream, especially oil producers, as a hedge against, some sort of catastrophe in the world affecting energy.
Yeah. It's interesting. Just before we came on here, I was seeing headlines on my screen, attack on Hamas leadership in Qatar by Israel. I don't know, a small impact on the oil market there, but it does underscore that the geopolitical issues, whatever you want to call them, they're always out there. They're ever present in the energy markets, and I think it certainly is something that people have to just keep in the back of their mind when they're investing there, right? And this is for either of you.
Yeah. Well, I remember the 73 oil crisis. We were driving cross country from Iowa to California, and gas stations limited you to 6 gallons. When you're driving a 73 Plymouth that gets about 12 miles a gallon, you're stopping every hour to get gas
Yep.
and wait in line at the gas station. But, things can happen. Well, we saw it, when the Ukraine war started. Gas, crude oil jumped at least for a while.
Yeah. Elliot, I want to ask you on the supply and demand front. I mean, we were talking off camera about Chinese demand being one of these things that's kind of counterbalanced OPEC plus supply, right? Can you talk about that a little bit?
Yeah, well, China has been, we have visible global inventories, which are reported, fairly frequently. For example, the United States being the most visible oil inventories in the world. You have Energy Information Administration reporting weekly. And, oil inventories are actually very tight. The amount of oil in storage in the United States is way below seasonal norms. We're also seeing, gasoline and diesel inventories at or below 5-year seasonal averages. And it's not really showing up in your other OECD or developed countries, for example, Europe. So, where is this oil going? You have growing production from OPEC, right? Saudi, really, when I say OPEC, I mean Saudi, because they're the only ones who actually they're the only ones who actually manipulate their supply according to what they say they're going to do. But a lot of their excess production is going somewhere, and a lot of that's ending up in Chinese strategic petroleum reserves. Longer term, I'd also look at India as being another developing country which is seeing very rapid growth in oil consumption. If you look at history, right, as countries reach a certain level of development, energy energy demand stops growing at a linear pace and starts kind of going parabolic because you have every individual person per capita is using more energy because they're starting to drive cars for the first time. They're developing a middle class. We saw it in the United States, we saw it in Japan, we saw it in South Korea. We're seeing it in China play out over the last 20 years, and now we're seeing it in India. And so, the longer term picture, I think demand growth for oil is going to be strong. And I don't see a peak in global oil demand. And at the same time, I think what you've got is a lot of people looking for a lot of incremental barrels from the US. US oil production is flat. I think that's where the disconnect is over the intermediate to longer term, where demand's still growing, production from non-OPEC countries flat. OPEC is now pushing out all their spare capacity. Where's the oil going to come from once demand catches up to that excess supply? But right now, yeah, Chinese demand to fill their strategic petroleum reserve is what's preventing or forestalling a larger build in visible global inventories.
Let's talk about alternatives. I think we have to, and that sort of, the energy transition. Such a hackneyed term, but where do either of you feel like we are in that process? And do you find a lot of opportunities in that, or are you still just mostly looking at, traditional oil gas plays, whether it's upstream, midstream, or what have you?
Um, yeah, wind and solar are kind of at a crossroads now because what has paid for most of it has been, government tax credits for the last couple of decades. I live in the Midwest where there's windmills everywhere. There really are. But it's, solar is probably a more viable solution. As an alternative energy, there's a company called Energia. It's a private investment. Don't have to be accredited, but they are doing solar stuff in South Africa and Brazil, and paying a nice, double-digit dividend income, growing their business down there. You can just go look them up, Energia, and just invest directly with them. I've had them come in and talk to my subscribers on occasion. I mean, the real, and it's hard to invest because, I think the real story is in SMRs, small modular reactors. If you've seen what Oklo's done over the last year, up 1,000%, and they won't build a reactor for another 3 years, but and I'm not sure how you're going to find that to be investable. You can invest in uranium, um, you know, keep an eye on these stocks, and if for any reason they pull back a lot, you can pick up shares. But if their Department of Energy did put out some grants a couple weeks ago
Yep.
for 10 companies to speed up the production of small modular reactors. Oklo was the only publicly traded company on the list, but there's another one there that's going to go public later this year with a SPAC merger. So if you can just go find that DOE memo and pull up the companies and start keeping an eye on it.
Gotcha. Gotcha. Elliot, same question to you. I mean, how do you
Yeah.
look at alternatives in terms of their attractiveness as an investment relative to traditional oil and gas plays?
The truth is, in my view, there isn't really an energy transition. It's not really a transition in the sense that we're moving away from one source of power to a new source of power. It's more of what I would call an augmentation, where we're adding new sources of power, layering it on top of an existing base. I mean, look, last year, 2024, oil, coal, and natural gas, what I call the big three, 86.6% of global power. Okay. If I go back 10 years to 2014, it's like 87, 88%. So not much of a shift there. If I add in nuclear and hydro, it's 95% of global power last year. Energy for all sources, transportation, electricity was from those sources, the big three plus nuclear and hydro. And in fact, if you look at China itself, it doesn't have an energy transition policy. They have a policy, which I won't try to pronounce it in Chinese for you, but it's build now, destroy later, or break later is their policy, their official government policy. Everybody talks about all this growth we're seeing in solar, right, in China in recent years. But the reality is they're building coal plants, new coal-fired facilities, natural gas, nuclear, right? All these things are growing and actually accounting for more growth in China over the last several years. If you look at since 2014, total growth in Chinese energy demand, natural gas, oil, and coal account for more than 80% of the growth. Solar is less than 10%. So I think that if you look even within the United States, you'll also see this. Where I live here in Florida, we're one of the fastest growing states for solar production. California is another state that's very, very, very rapid growth in solar energy output. The difference is, Californian electricity prices are multiples of the national average. Florida is basically in line with the national average, despite the fact we have no real domestic source of fossil fuels here in the state of Florida.
Yeah.
It's all imported from other states. The difference being that Florida has added solar on top of its existing base of mainly natural gas, coal, and nuclear fired power facilities. California, that's more of an augmentation strategy, if you will. California has been much more of a transition strategy. They've built all the solar, all these intermittent sources of power generation, and they've retired coal plants, they've retired natural gas, they've retired nuclear. And as a result, their power prices are spiking because integrating an intermittent source of electricity generation into the grid is very, very expensive. So I actually think the biggest play on alternatives, and I kind of been sort of beating this drum the whole talk, but it's natural gas, because natural gas is what's being used. Natural gas fired facilities can be thrown up quickly. They're relatively environmentally friendly compared to coal, for example, and they can be used to feed power into the grid when the sun's not shining, like at night. Or the wind's not blowing at the right velocity to run a wind turbine. And I think you're going to see natural gas be the leading beneficiary in developed countries anyway from the build out of renewables.
Okay. I definitely want to get into picks and ideas, but briefly, for the last part of this presentation. But before I make that transition, if you will, I do want to just ask about politics. I mean, we've talked about sort of Trump 2.0, the drill baby drill environment, and that's what the administration would essentially like to see, or at least help permit when it comes to versus what you might have seen under Biden. How is that impacting prices? Is it really a force, and how is it impacting the businesses that you follow? Do you think politics are a big part, or really not a big part of what's going on in the energy space? And this is for either of you.
All right. I think eventually it will be. Secretary of Energy Chris Wright, founder and CEO of Liberty Energy, an oil field services company, and then Doug Burgum, North Dakota, former governor, big energy state. These guys are going to push to make at least things easier for energy companies. Less paperwork, less regulation. But then the flip side of that is U.S. energy companies have become very, very disciplined compared to the early days of the shale revolution. They're not going to overproduce and drive down prices. They're going to produce what they can to maintain profitability. But when prices are good, they'll produce a little more. When they're not, they'll produce a little less. But so, despite what the government would like, drill baby drill, drive oil down to $40 a barrel, I don't think the producers would be happy going in that direction. But the flip side of it is their businesses are going to be easier to manage and run under the current administration.
Yeah. Anything you'd add to that, Elliot?
I would say not much. I would say, drill baby drill really to me is more about removing impediments to drilling rather than forcing energy companies to drill more. I mean, the United States is not a socialist or communist country where the government says drill more, produce more. Companies make this decision based on the prevailing price of oil and natural gas. How much money, how much free cash flow can they generate? That's discipline, right? And so I think that, that we haven't seen that, right? We've actually seen drilling activity go down on a lot of these basins on the oil side, particularly since the election. I would say the one area that I think it was an immediate boost for is LNG, because there was an LNG moratorium under Biden that's been lifted, and that probably provides some additional visibility for future export capacity growth for natural gas.
Okay. Just as a reminder, anybody who's watching us, as Charlotte noted, there is the chat box. If you think of any questions, obviously this is your time to get them answered in real time. So please do type them in there. Charlotte will let me know, and I'll ask her in a few minutes just to see if there's anything in the queue. But in the meantime, I did want to basically give each of you, and I'll start with you, Tim, your best idea right now. I guess in your case, you were talking about upstream and midstream. I don't know if you want to maybe share one in both, and what you like about those companies.
Yeah. Uh, Upstream first, it's a newer company out there. I don't know if I pronounce this right. Vitesse, stock symbol VTS. They're kind of a combination of a royalties with a production arm attached to it and operating up in the North Dakota region. Very, very focused on supporting their dividend. And it's a high single digits yield. I mean, probably a couple years worth of dividends they've paid so far, and just added it to one of my portfolios 5 or 6 months ago. But very, very interesting company. If they can, and they're really focused on managing their cash flow to support the dividends to investors, which we get a lot of other upstream energy companies. We can talk about something, they want to give a certain amount of cash flow back to investors, but lately they've been doing more share buybacks than cash dividends, which is something I'd like. We could talk about share buybacks for a while. Midstream, kind of KGS, Kodiak Gas Services. They're a compression company. So it feeds into what Elliot's saying. If we're going to just pump more and more natural gas, they need compression. And it's a fairly young company. EQT owns like a third of them. And I just saw this morning EQT is selling some of their shares in it. So that could put a little downward pressure on the shares. But it's kind of a not well-known midstream company. Should be able to steadily grow their dividends, and 6% yield, I think I saw this morning.
I saw it was VTS and KGS, was it?
Yeah. Yes.
Okay. Perfect. Elliot, again, you don't have to sort of delineate your picks in that upstream, midstream section. Pretty much if there's two best ideas almost anywhere in the sector, we'd love to hear about it.
Well, I love EQT as a gas producer as an upstream name. EQT is the now the second largest independent natural gas producer in the U.S. behind Expand Energy, which is the old Chesapeake, which I also like. But EQT, I mean, I think what they really did last year, which was a good move, was they purchased their former midstream subsidiary, Equitrans. And so that's given them this integrated upstream and midstream base. They're a producer in the Marcellus Shale, which is in Appalachia. That is the lowest cost natural gas shale play in the United States. And now they own all this midstream around that. And what that's allowed them to do is really tackle this in-basin demand market. So what that means again is there's some old coal-fired facilities too in the state of Pennsylvania. I think there's some in Ohio they're looking at as well. And so they're converting these old coal-fired facilities. These are decades old. They've been retired or closed down. They're converting them to burn natural gas. They're co-locating a data center, an AI data center on the site. And EQT is actually contracting to provide to sell gas to that captive facility. So it's another source of natural gas demand rather than always piping the gas, to the southeast here to Florida or down to the Gulf Coast for export. So on the upstream side, I mean, I like EQT, I like Expand as well, which has operations in the Marcellus as well as Louisiana, which is directly for the export. If you're looking for maybe a little higher stakes play or higher risk play, I think Venture Global is a really interesting stock. It's a name we recently added to the portfolio on my service. And what they are is they build these liquefied natural gas export facilities. But it's a little different than the Cheniers of the world, which basically building an LNG export facility, this massive construction project, takes 5 to 7 years to get this thing up and running. Venture actually focuses on what is called a modular design. So the bits and pieces of the facility are built in a factory, and then they're brought, and simultaneous with that, the site is prepared. Those modular pieces are brought on site, and it allows these plants to be brought up and running much faster than traditionally has been the case. Their last couple of facilities on the U.S. Gulf Coast brought on stream from final investment decision to first gas 2 years, a fraction of the time. So I think this is a name that it just IPO'd back in February, I believe, late February. So it's still kind of a volatile stock all over the place, but I think it's interesting longer term. They could be theoretically the largest exporter of liquefied natural gas by the early 2030s because they're able to bring these plants on stream so quickly. Whereas traditionally it's been a very long-term construction project.
What was the ticker on that one?
I got
VG.
a VG. I got a question for Elliot. What are your thoughts of Antero Resources versus EQT, kind of the two big players in the Marcellus?
I see. I like EQT because if you look at what their focus has always been, it's always been on bringing down their production costs as much as possible. And they already had the lowest production costs of any dry gas producer in the United States, in the sense that they don't produce very much natural gas liquids on their properties. A lot of other producers that you hear that have lower production costs, Antero and Range Resources being two, they have a lot of natural gas liquids production. The other thing is, EQT by buying Equitrans last year, they actually came under a little fire for that at the time. The stock got hit a little bit, but the reality is that's actually driving their production costs even lower. In the next few years, EQT could have production costs in the 150 range, $1.50 a million BTU range, which is lower than anybody else out there. In the Marcellus, the key is to have access to midstream because there's not a huge amount of demand locally. But EQT is changing that by building these in-basin demand facilities, but also they have access to the Mountain Valley Pipeline now through the Equitrans deal, so they can export gas, get gas to market. That's the key in the Marcellus to me, is having that access, that preferential access to pipelines.
Answer your question, Tim?
Yeah. The whole EQT's midstream Equitrans was a mess for a long time just because of the Mountain Valley Pipeline.
Yeah.
Trying to get final approval on that took them it seemed like forever.
Yeah.
And
Well, it only came about because of an act of Congress, basically, right?
yeah, the
So,
environmentalists were holding it up, so they couldn't cross this 5 foot wide stream, um, something like that. But
Oh yeah.
so and I follow Antero Resource and Antero Midstream, which has been an interesting, midstream companies. I like dividend growth. Antero Midstream hasn't grown theirs in several years, but the dang stock keeps going up, which is just, if your stock keeps going up, you have no reason to sell it. And hopefully at some time they'll get back to growing the dividend again.
Yeah. Charlotte, in the last couple of minutes we have, do we have any questions in the queue?
Yeah, we do have a few questions here. I'll start with this one from Terrence. They had asked, why would Biden have drained our strategic oil reserve? And are there any movements by the Trump administration to refill it?
I'm not sure who wants to take that one.
Yeah, well, they drained the strategic. I'm not going into the why part. The refilling part, they're trying to, but it got drained down so low they got to do some repairs to the reserve facilities, the salt domes where they kept all the oils. It got the oil is taken so low. There's repairs and they need to be done. They want to start refilling it, but from what I read, they've got to get some repairs done in there first.
Right. Joel had asked, do you guys see natural gas prices continuing higher?
I generally think that gas prices are too low right now, and I think that a lot of the weakness we've seen over the summer in the front month and the spot prices has been due to the coolest summer since 2021, a big shift in favor of coal generation through the summer over natural gas. But longer term, prices are already much higher. If I look at futures expiring early next year, maturing early next year, gas is trading upwards of $4 a million BTUs, which is plenty high enough for a good quality producer like an EQT to make plenty of free cash flow. So I do think gas prices are going to average $4 plus over the next several years.
Yeah, and longer term, Elliot has it right. Natural gas is really the energy of the future for many, many purposes in much of the globe. And, LNG is going to push that. More and more LNG capacity means they need more and more natural gas so they can ship it around the world so people can have clean burning natural gas. And it's the demand growth from LNG is slow and steady, but it is steady. And, you think, again, as Elliot said, out into the 2030s, how much LNG we're going to be producing. Qatar is producing it. I think Russia's starting to produce some too, I believe. And that's a very profitable business for those companies because at the end markets, LNG sells for many multiples of, the $3 or $4 that local producers can get paid for it. And that will be a big driver over the next decade or so to drive natural gas prices higher.
Okay.
Thanks, guys. I know we're short on time. I'll try and squeeze in another question here. Asha had asked, are there any good books that you would recommend for someone who is interested in learning more about the energy markets?
Good books. How about it? I mean, some people are still reading books. I love to hear it.
Subscribe to Doomberg, Doomberg. It's a Substack. Elliot, are you familiar with them?
Yes, I am. Yeah, I'm on Substack as well. So,
Yeah.
I do read some of his stuff. It's some interesting takes on things.
He's got very interesting takes, but he, brings a lot of good data to his stories and stuff too. So
One interesting book I've read in recent years is Ali Al Naimi. He used to be the energy minister for Saudi Arabia up until, that was 2015, 2016, I think. He was energy minister for a long time. He wrote a book, I think it's called Out of the Desert. And it talks a little bit about Saudi energy policy over the years. And I think from a long-term cycle perspective, that's an interesting book to read because you really get the inside view of what happened in 2014, where Saudi Arabia started increasing the production of oil and kind of flooded the market. What was going on in Saudi Arabia's sort of collective minds at the time. And they did something very similar in 1986. So I like a lot of these sort of historical energy books because I think it provides some perspective on some of what we're seeing today.
Well, I know we are basically out of time, but before we go, since we're talking about where people can get more information, Tim, starting with you, what website can somebody go if they want to learn more about your services and subscribe?
InvestorsAlley.com.
And same to you. So investorsalley.com, and Elliot, for yours?
I put up a lot of free content on my Substack, substack.com. The name of the service is Free Market Speculator. I provide a lot of free content about energy there. And then I have a paid service, Energy and Income Advisor, at energyandincomeadvisor.com.
Okay. Well, thank you so much, Tim. Appreciate your time. Elliot, same to you. Charlotte, great job as always with
Thank
the
you.
moderating. Appreciate you keeping everything on track, and ready to roll into the next session.
Thank you,
Absolutely.
guys.
Thank
Big
you.
thank you to those in the live audience, and be sure to stay tuned as we have a lot more in store for you in this Money Show Virtual Expo. Everyone, take care.
Bye.